Personal use, entertainment, and why standard industry fare level does not save the deduction. Hello again. This is Forrest Owens. I'm an aviation lawyer, a private pilot, and an FAA licensed airframe and power plant mechanic. Now let's turn to the second major IRS issue. And this is why many large turbine owners become unintentionally optimistic. Personal use of aircraft is not cured merely because the company owns the aircraft and the trip happens to involve executives. The tax system separates at least three questions that owners often collapse into one. First, is the flight business, personal, commuting, or entertainment? Second, must value be included in someone's income as a fringe benefit? Third, even if there are income exclusions or inclusions, how much of the aircraft expense remains deductible to the company? Those are different questions, governed by different rules, and large turbine aircraft create mismatches between them. Remember this. SIFL, or Standard Income Fare Level, may value the ride, but it does not automatically rescue the write-off. Treasury Regulations Section 1.61-21G provides non-commercial flight valuation formula, commonly known as SIFL. The value assigned under SIFL can be much lower than the actual hourly cost operating a large turbine jet. That is why owners and executives sometimes feel comfortable once they hear that personal flights are being picked up as income. But compensation inclusion and expense deductibility are not mirror images. Section 274 and Treasury Regulations Section 1.274-10 are where the trap becomes real. Current law disallows deductions for entertainment expenses and for facilities used in connection with entertainment, including aircraft, except to the extent a statutory exemption applies. The IRS's own guidance tells examiners to focus on direct and indirect aircraft cost, including depreciation, pilot wages, interest, insurance, and hangar fees, and then allocate those costs using one of the permitted methods. That means a large turbine owner cannot simply say, the CEO had income, so we're done. The company still has to determine whether the flight was business or entertainment, whether guests were on board, whether a spouse accompanied the executive, whether the travel had a bona fide business purpose, and whether the company is entitled to a deduction exemption. The regulations also require consistency in the chosen allocation method for that year. A real-world litigated example helps explain the danger. In Sutherland Lumber-Southwest versus Commissioner, the company allowed officers to use a corporate jet for personal vacation flights and included the value of those flights in income under the SIFL rules. The taxpayer won under the law then in effect, and the Eighth Circuit allowed the company to deduct its costs. But that case is memorable precisely because owners still cite to it too casually. Congress later tightened the law, and today, post-Tax Cut and Jobs Act 2017 landscape is materially less forgiving for entertainment use of business aircraft. So, while Sutherland remains important, but mainly as a warning about chronology, a case may be famous in aircraft tax planning and still dangerous if someone quotes its result without quoting its date. The IRS has made unmistakably clear that this area is an active compliance target. In February of 2024, the service announced plans to begin dozens of audits involving business aircraft and personal use. That announcement matters because it identifies the exact place where sophisticated taxpayers most often get careless, classifying allocation and substantiation of use. What does this look like in the real world? An executive takes the family to a sporting event on the company's large cabin aircraft. The company imputes SIFL income to the executive and assumes the matter is closed. But if the trip is entertainment, the company may still face deduction disallowance. If guests travel, the calculation gets harder. If a spouse joins without a bona fide business purpose, Section 274M(3) can become relevant. If the passenger manifest is incomplete or the stated business purpose is vague, the audit becomes a credibility test. That is why the passenger list is not a hospitality detail, it is a tax document. On a large turbine aircraft, every seat can change the answer. The practical strategy here is disciplined classification. Every leg should identify passengers, the role of each passenger, the purpose of the trip, and whether the purpose is business or entertainment, whether the flight is commuting, whether any reimbursement was made, and whether any amount was included in compensation. The process should happen close to time to the flight. Memory is not a tax control. Owners should also align payroll, tax, and flight operations. The flight department may know who was on the airplane. Payroll may know what was included in wages. Tax may know which allocation method was used. And the IRS will want to know whether all three systems tell the same story. When they do not, the return begins to look like it was engineered rather than recorded. In short, the common IRS issue with large turbine aircraft is the false belief that personal use is manageable so long as someone pays or picks up SIFL income. That is incomplete. The real issue is interplay between valuation, deduction disallowance, and proof. Remember this. Take this away. Keep this in mind. On a large turbine aircraft, the tax problem usually is not that the flight was personal. It is that the owner misclassified what the personal flight meant. Thank you for your interest in this information. This information is provided for informational purposes only and is not legal advice. If you have any questions, please direct them to admin@aviationlegalcounsel.com. We look forward to helping you navigate these issues with precision.